Property prices are rising across the U.S., and that is, in fact, in part because of these higher interest rates.
Correct.
The wait list for public housing is over 18 years.
Experts in Britain are warning that a generation of young people may never be able to own their own homes because of a grave housing crisis.
Back in 2008, banks and other financial institutions gave out loans to people who were not creditworthy. Then, they repackaged these loans as mortgage-backed securities and sold them to investors. When homeowners began defaulting on mortgages, the value of these securities dropped, leading to significant losses for investors. To make matters worse, banks borrowed to invest in mortgage-backed securities and other risky investments. As investments began to fail, these institutions gradually folded up, leading to widespread freezes. The market crash of 2008 had severe economic consequences. Millions of Americans lost their homes and jobs, while businesses struggled to stay afloat. The economy of many countries slowed down, and the world felt the heat. After the issues were resolved, it felt like we wouldn't make the same mistake again. But guess what? A 2008 housing market crash is coming. The signs are out there. Welcome to our channel. In today's video, we'll discuss the possibility of another housing market crash and the telltale signs that may lead to one. Could it be worse than the one we experienced in 2008? You're just going to have to be the judge. One of the first clues of an imminent housing crash is the economy. It is the overall indicator of an impending housing doom. It affects the demand and supply of houses. When the economy is up, unemployment is low, and consumers go on a buying spree like there's no tomorrow. But if we flip the same coin to an economic downturn, it means that people have less money to spend on buying houses and are unsure about their financial future. They become financial ninjas overnight. Simply put, consumers become careful not to be caught in financial rainstorms. Rather than splurge on houses, they shore up cash and build emergency funds. Let's remember that recessions are unpredictable. It triggers an increase in unemployment, meaning businesses start trimming their workforces without restraint. Before making a big real estate purchase, one must be sure that they have a stable income source. Losing your job or facing short-term financial hardship can ruin your chances of paying your mortgage. If this happens, sellers will have trouble finding a buyer for their homes, which automatically decreases home prices. The victims of falling house prices are homeowners, especially with these mortgages. They're caught in a tricky web and can barely get out. If the property value decreases, it reduces the mortgage that you've already paid off. This means that homeowners automatically owe more to their lenders than the value of their homes. This was precisely the situation during the global financial crises. Of course, lower house prices sound like a treat to first-time homebuyers because homes are more affordable. However, it creates uncertainty because it could decline further into the future. The construction industry is not immune from the roller coaster ride either. Developers have slowed down or halted new projects due to reduced demand. Global inflation is soaring, and there's a fear of an impending recession. There's no end in sight for right now. U.S. home sales sagged for the third consecutive month, slipping by 0.7%. Worse still, all four major U.S. regions are suffering declines. On the brighter side, real estate forecast firms like Freddie Mac and Zillow predict that home prices will rise in 2024. Only time will really tell. Just when we thought things couldn't get crazier, mortgage interest rates are hitting the roofs. People want to spend less on housing, but are forced to pay more on their mortgages. What then happens? The rising interest rate is a huge indicator that the housing market is gradually slipping. When interest rates are low, it's like winning a jackpot for home buyers. It's a normal human instinct to be excited about those sweet interest rates when buying a home. But when these rates increase, people are less likely to buy. And when demand declines, sellers will have a hard time finding buyers for their homes. You see, a low interest rate means that the cost of a mortgage payment is far less than rental income. Therefore, there is an incentive for people to invest in housing. But as interest rates go higher, the incentive starts changing. It gets to a point where the monthly mortgage payment becomes higher than rental income. When this happens, there's no motivation to purchase a house. The U.S. Federal Reserve is to blame for this negative spiral. It recently raised interest rates to tame inflation. The goal is to reduce consumer spending and sharply fall prices. This decision saw rates jump from 5.25% to 5.5%. So far, inflation in the U.S. has reduced significantly, and prices are relatively down. However, homeowners are breaking a sweat. Here's a clearer picture of what's going on with interest rates. According to the National Association of Realtors, the average monthly mortgage shot up by a whopping 85% in the past 20 months. That is, it jumped from $1,212 in January of 2022 to $2,243 in September of 2023. New homeowners are stuck between the devil and the deep blue sea. They either make a giant down payment or budget more of their monthly budget for housing. How many Americans can really survive on that? Rising interest rates also mean that some homebuyers cannot meet up with their mortgage payments. What happens if they can't keep up? It's simple. The house is foreclosed. With rising interest rates comes the inability of homeowners to pay their mortgages. Foreclosure is never a good sign. In 2008, when it reached this level, it was a stark symbol of the Great Recession. Fast forward to today, experts are saying we can brace up for a housing crash worse than 2008, where there are more foreclosures than usual. It means that most people can't pay their mortgages. It also means more houses in supply than demand. In the first quarter of 2023 alone, lenders repossessed nearly 96,000 properties. Factors like rising property taxes and unemployment rates are driving these foreclosures. Already, the tech sector recorded thousands of layoffs this year. Most homeowners cannot afford their new tax bills, especially with the impact of inflation on household expenses. Even more depressing is that the U.S. workers' incomes remain lower than their pre-pandemic highs as the cost of consumer goods and services continues to rise. For instance, a full-time worker's median weekly earning was $363 in the first quarter of 2023. Compare this to $367 in the first quarter of 2020. At this rate, the chances of falling behind on payments are much higher. Foreclosure-related filings in the U.S. skyrocketed in May of 2023. According to ATTOM, a real estate data group, over 35,000 properties were up. Florida took the crown with 2,901 foreclosures underway, followed by California with 2,451 and Texas with 2,286. Illinois and New York followed suit with 1,358 and 1,287, respectively. To prevent foreclosure, some homeowners may decide to sell their homes, but then the real estate space is already saturated with so many homes and so few buyers. This may cause some issues. At the beginning of the year, experts were all smiles, believing that the housing market would bounce back. Fast forward a few months to the end of the year, and it's still gloomy. Mortgage rates are still playing hard to get, and potential buyers are waiting for these rates to drop before making a move. Those who put up their homes for sale will have to wait longer for buyers. So far, sales have nosedived, and Realtor.com predicts it will crash a further 0.6% by 2024. At first, the group predicted a 14.1% decline in sales throughout the year, but this decline has already exceeded 15%. Sales of single-family homes decreased by 1.9% to 3.65 million, while condo sales sank by 4.5% to 0.42 million. Sales are weakest in the Midwest, Northeast, and South, but grew in the West. The inventory of unsold homes ballooned to 1.1 million by the end of July 2023. And if that's not enough doom, international buyers are gradually pulling away from the U.S. housing market. blame it on soaring mortgage prices, inflation, and a strong dollar, making purchases less financially attractive. From April 2022 to March 2023, international buyers bought up 84,600 homes. This may sound like a lot, but it is a staggering 14% drop from last year. Ironically, they purchased fewer homes but paid more for them. China, Mexico, Canada, India, and Colombia were the top 5 buyers in the U.S. Chinese buyers had the highest average purchase with 1.23 million because 1/3 purchased homes in California, where home prices are highest. So, with more international and domestic buyers holding back, it's easy to see why a 2008 housing market crash might be imminent. A housing crash is something we don't want to happen. But what can the government do to prevent it? Share your thoughts in the comment box below. And as always, thank you for watching.